Several changes were made with respect to the mortgage interest deduction. Under prior laws, mortgage interest was allowed on a primary and secondary residence up to $1 million in acquisition debt and an additional $100,000 in a home equity line of credit. Debt for new loans after December 15, 2017 is limited to $750,000 of principal. Home equity loan interest is no longer deductible, regardless of whether it's new debt or existing debt. There are some transitional rules if you had an agreement to purchase a home before December 15, 2017. Prior acquisition debt can be refinanced without jeopardizing deductibility. However, taxpayers cannot increase the amount of principal at the time of refinance. Refinancing a home equity loan into your mortgage doesn't automatically make it deductible. You need to be especially careful if your new mortgage exceeds $750,000. Pre-existing debt is grandfathered up to $1 million, but it's not allowed to increase the principal of your current mortgage. I think this will become more of an economic decision in the future since home equity isn't deductible. People will start to look to other loans like auto loans, student loans, and personal loans to get the best rate and best repayment terms for their personal situations. The state and local tax deduction was also significantly reduced. Under prior laws, individuals could deduct property tax and the higher of sales tax or state and local income taxes paid during the year. The new laws cap the total state and local tax deductions at $10,000. The $10,000 deduction is the same regardless of your filing status, so a married couple is not allowed to deduct $20,000. When initial drafts of the law were released, many saw an opportunity to prepay future years' taxes and take the deduction in 2017. However, the final version does not allow a deduction for 2018 taxes in 2017. Residents of high income and property tax states will easily max out this $10,000 threshold. Some states are already calling this unconstitutional and are actively trying to change this portion of the law. We'll keep watching to see what happens. The $10,000 does not apply to property and sales tax incurred in carrying on a trade or business, so individuals will not be limited on those deductions. This limit, along with the increases to the AMT thresholds from the Act, will also help keep many taxpayers out of AMT, since state and local income taxes were typically one of the biggest add-backs for the AMT calculations. All of the miscellaneous itemized deductions subject to 2% have been repealed. There are many different expenses that were previously deductible in this category, so I'll touch on a few of the more common deductions. Unreimbursed employee expenses, including the home office deduction for employees, are no longer deductible. Tax preparation fees are also no longer deductible unless they relate to trade or business income. Investment management fees paid will not be deductible. However, investment interest can still be deducted as an itemized deduction. The limit for cash contributions to public charities increased from 50% of AGI to 60%, allowing larger charitable deductions to be taken each year. There is one big change for die-hard college sports fans. Previously, donors were allowed to deduct 80% of the payments made to universities for the right to purchase athletic tickets. That deduction is now disallowed. More individuals will be taking the standard deduction, so itemized deductions will not matter as much. But we know St. Louis is a generous community and will continue to give even if they're not getting a charitable deduction. We believe there will be a bigger emphasis on timing, so people may double up their contributions in 1 year or use a donor advised fund to itemize deductions 1 year and take the standard deduction in alternating years. Qualified charitable distributions will also become more important in 2018. Individuals who are 70 and a half and older will be able to distribute to charity directly from their IRA and not have to include the IRA distributions in their income. Here's a simplified example of the changes between 2017 and 2018. Medical expenses are deductible for 2017 and 2018 for the portion of expenses that exceed 7.5% of AGI. After 2018, the 7.5% increases to 10%. The next three deductions are state and local income and property taxes. Those will be limited in 2018 to $10,000 for the entire category. Mortgage interest and charity would continue to be deductible as long as the limits aren't exceeded. And the miscellaneous itemized deductions are repealed for 2018. We go from $40,000 of allowable itemized deductions in 2017 to $23,000 of itemized deductions in 2018 for the same expenses. With the significant increase in the standard deduction, in this example, taxpayers would have been itemizing in 2017 and then would be better off taking the standard deduction in 2018. I think this will be a fairly common scenario for many taxpayers, and many may look to timing their deductions, especially charity, if they're on the verge of itemizing versus taking the standard deduction each year. This question really depends on your personal situation and the specific deductions you are taking. While there is a very limited amount of itemized deductions you can take this year, the decrease in tax rates, an increase in tax brackets, and the increase in the AMT thresholds will all help to reduce the tax that individuals are paying. The child tax credits also expanded significantly, and business owners especially will be able to take advantage of a new deduction to offset some of their business income. Stay tuned to our blog on our website at anderscpa.com and sign up for our newsletter to get the latest information. And as always, reach out to us with specific questions and we'll be happy to help you make sense of the new laws for your personal situation.